Great. Hi, I'm Minda, and over there is Yoko. At least that's how it looks on my camera. And I just want to thank Monica and Joni for inviting us here today for a group that I have heard about for a long time, but never had the opportunity to really get involved with before. So really excited to get to share this with you today. It's something Yoko and I love talking to women about investing. And I think that'll come through as you hear us over the next little bit here. Just first, we're partners, who we are. We are former startup operators in our careers, and then turned angel investors. And then we recently launched First Row Partners, which is a venture firm, so venture capital. And so we can speak to a couple of different angles on this startup journey and experience and funding. Really quickly, I want to just go through what our agenda is. And what you'll notice is that the first section is really us talking at you, which is not how we usually do things. We're very interactive. But the slides will be available, so please don't feel like you have to grab everything and every detail. All the links, all the details, fully available. And then we'll hit some breakout sessions where Yoko and I will each take a room, and then we'll come back and we'll recap those conversations and do some Q&A. So our hope is that you've come curious and you will leave with some information and feel like you have a path forward to explore and learn more if that's where you're headed. Or maybe you'll just be telling somebody that you decided that, you know, this is not for you, but which is also something else. It's considering something like this that I think is really relevant, and I hope why we're all here. The other thing I want to mention that this is, we're going to be talking about investing, but we're not giving you investment advice. What we're sharing is our personal and professional, just general point of view, and from our experience, what we've learned and want to share with other people who are just on that education path as well. So just a note on that. Yoko, I'll let you kind of take this next section about why people might be here in the first place.
So typically in an event, like an in-person event, we'd be doing the, hey, raise your hand if you're, you know, if you fit this bucket, just to get a sense of who's in the room. We can't do that today in a virtual setting, but maybe in the group chat, if you could just jot down what brings you to this event, you know, whether you're a founder who wants to know more about that investor mindset, if you're interested in investing in startups, but you've never written a check, or maybe you've written a check before, but you just want to continue to deepen your understanding, or whatever other reason there is, you know, please just add it in chat so we can sort of see the variety of folks. That'd be great. And one thing I also have to say is when I get really happy when I see founders at events like this, because they're really doing opposition research is like sort of the maybe negative way to say it, but it's really, they're really trying to understand the motivations of the person across the table from them. And I think that's a wonderful thing to do. And I say the same thing for investors, you know, go to all the founder focused events so you get to really understand their motivations as well. I think it's always important to know that where your values are aligned and where they're not, or where your incentives are aligned and where they're not. So you can sort of, it's actually exciting. And I have to say too, Minda would probably agree. We both ran rounds of Seattle Angel Conference, and trying to get more women on the investing side of the table. It was hard trying to find folks who wanted to lean in. And so I am so thrilled to see so many women here saying that they're interested in investing. So we're excited about that.
So what I'm seeing is that there are a lot of women interested in just knowing more about investing, whether it's, you know, pretty soon, right now, or in the future. Yeah. And I think that's super exciting. And some women that are looking at, you know, the entrepreneurial leadership kinds of courses. And I think that entrepreneurial, in the earliest stages of startups, I think in the kind of investor that you find and the kind of operator you find are more alike than different. And so I think it's all very entrepreneurial, and Yoko and I spend a lot of time trying to sort of bridge those gaps and reduce any power and information imbalance. So that's part of why we're here.
Yep. And speaking of that, you know, before I wrote my first check with my partner, I didn't even know that early stage investing was available to me. You know, so for really, this is for Yoko of a number of years ago, you know, and really trying to get the information out in terms of what are the opportunities that are available? What are the types of questions I should be thinking about? So, you know, we'll do a few just kind of basic terminology type things. So what's an angel investor? You know, at the core, an angel investor is somebody who invests personal capital into a new or small business venture, you know, providing capital to start up or to expand. And, you know, what you hear about in angel investing in media, whether it's like Shark Tank or not, whatnot, you think about these gigantic check sizes and these, you know, crazy opportunities. But, you know, but it's actually helpful to know that that's not what most angel investing looks like. And I also, again, want to differentiate. You can invest as an angel into businesses that are not venture scale necessary. And what we mean by venture scale is really companies that can scale quickly in size. And often you'll hear them talking about billion-dollar or trillion-dollar market opportunities. So, you know, you're really looking for that hockey stick. But you can also invest in non-venture scale businesses. For this hour, we'll be focused mostly on venture scale businesses, but there's a bunch of angels in town who focus on Main Street businesses. So the return profile will look different, but you know, that's also an opportunity as well. So, you know, how do you get your wings? Is there some special test you have to take? You know, often the question is, how do I prove that I can invest? Well, the reality is there's not really, the requirement is really to be an accredited investor, and there's some specific guidelines on that. They're listed here. So an individual who makes more than 200K or 300K with a spouse with at least 2 years with that ongoing expectation. You know, there's sort of these parameters here. And just a quick note that previously only accredited investors could invest in startups, but with the Jobs Act in 2012, this did open up the asset class to non-accredited folks using crowdfunding platforms. We will not be talking about that crowdfunding aspect of this, but you know, we will be talking about kind of the direct or investments, kind of having a direct relationship with the startups. We'll also be talking about how the types of percentages you should be allocating to this asset class, because there is some risk with it. So, but really the biggest thing is there's not a ton of requirement. This is it.
It's defined by the SEC, so you can also put it there too. And as angels, you might be wondering, well, how is that different than VC? And VC is different, and this is sort of an org chart of VC, but I want you to understand a little bit about how it is, since you may be investing alongside them, or they may be coming in as investors to companies you've invested in early, and you want to understand a little bit about how they're set up and architected. And essentially, I want to focus on the white box, this limited partner. You'll hear the term LP quite a bit when you hear about, you know, venture capital firms. LPs are the investors. They're high net worth individuals, maybe a family office, maybe a pension fund, a large foundation. Those are organizations that are looking to be investors in a fund, and they pool their money into a fund. And the red box, the venture capital managers, are the ones making the decisions about how to source the investments and how much they invest, when they invest. All those decisions are really up to those folks, and they get paid a commission and a fee to do that on behalf of the investors. The venture capital firm has a fiduciary responsibility to those investors, and when they go and approach those investors for investment, they say, here's our investing thesis, here's the time frame that we're going to deploy your capital, here are the types of companies that we'll be investing in, and this is the portfolio strategy that we're going to apply. We're going to, you know, no less than 10% ownership. We're going to, you know, they have much sort of a tighter box that they've defined for their investors, so that their investors are pooling their money, and then over the course of, let's say, 10 years, are getting a series of returns that, that they're looking for. So just a little bit about what that is and how that's framed, because the next slide is a little bit about understanding how they work differently. It's money, but it's money that's a little bit different. So I like to think of angel funding as gas for the car that gets you to the launch pad, and then VC money is like rocket fuel that can get you to the moon. It's really important to note that if you put rocket fuel in a car, you're just going to blow it up. So the wrong kind of capital for the wrong vehicle, the wrong time, can really cripple a company and really destroy the opportunity. Likewise, sometimes people just are straight at the launch pad with all the rocket fuel and they just blow up on the launch pad. They can't hit escape velocity because venture capital money is looking for opportunities that burn that money bright and fast. It's not long-term capital, it's a long-term investment. They want that capital to be substantial and go to high value, high multiple, high acceleration use. Angels often are investing at the much earlier stages in smaller amounts in order to prove that and help along the way to make sure that a company is making milestone progress to get to the point where they can really be that rocket ship. And so when they're on the same ownership, the cap table together, sometimes an angel says, wow, a $20 million exit looks great to me in 2 years. And a venture capitalist on that same board might say, oh, no, we're going to the moon, we're holding on. And so those differences of opinion are really about the alignment. So just pointing out that as you look at where angels play and where VCs play, it's just understanding a little bit different motivations, and one's personal, angels, one are and the other are professional investors. They are paid to deploy capital and produce a return.
Great. So, why are we and others in the space excited about investing in the space? And we'll also cover a little bit about what the early stage landscape looks like today. So first, high risk equals higher return potential. So angel investing is risky, but it does have high potential. There's been some studies done. These metrics are actually from quite a few rounds of study reports done by Robert Wilbank out of, I think, Oregon. But what this shows me is with discipline, with some thought, a 25% annualized return is a reasonable goal. But if you look at this most recent row, this update shows a 2.5x multiple over mean holding time of 4.5 years. So what Minda was talking about with these are longer term investments, and that 10% of the exits generate 85% of the returns. So I think again that we'll come back to that again and again. That angel investment is risky. It's one of the riskiest types of capital, but you can, if you're diligent about it, if you're thoughtful about it, and build a portfolio, you can certainly you can see some returns that are great. They're also largely uncorrelated with the market. So to some degree, like in an unstable space like now, it can provide it can offset, but again, keep in mind the risk, right? We'll talk about this more a little bit later, but the average failure rates of companies is 60 to 70% across your portfolio. So that riskiness is typically what drives folks like financial advisors away from this asset class. And also because of this risk, we don't, in addition to having a diversified portfolio, we definitely encourage folks to have it be a small percentage of their overall investable assets. So what we typically see is in the 5 to 10%. And again, where you are on that spectrum, it really depends on your risk appetite.
Right, and we'll talk a little bit about portfolio strategy for when you do, if you look at taking 5 to 10% of your investable assets and applying it, what kind of portfolio options do you have? So we'll get to that as well. So I want to talk a little bit about this slide. It has a 1-2 punch to it. Number one is the green dark bars. Those are the higher return potentials that have been demonstrated by venture over the years. So why would you invest? Well, it's about money returns, like money, producing money. It's wealth building. But there are also some really important aspects, and this has become clearer and clearer to me the more that I've gone from being a startup operator to being on the investor side, which is there is network access and power to be had by identifying as an investor and using your capital in this particular way. And I like this quote so much that Yoko found, which is, give a woman $1, she can put it to good use. Teach her about how money really works, and she can change the world. So I think that we all understand that by making a small investment in a world-changing idea very early on, we can often be a very vital propellant of innovation and new ideas and changing who the world works for, because the people who deploy capital are the ones making the decisions about what gets to get off the ground and who that world works for. And the more we expand the number of points of view that are coming in with the capital, I think that the world starts to work for more people. So really thinking about you as a steward of your capital and what you want it to be able to do for you and in the world around you and the world ahead. So I think that those are two really important ideas, and just sort of recognize the power that it is to be an investor and to be able to walk into rooms that traditionally, frankly, women haven't been in, and be able to talk about things that are the technology and the companies on the cutting edge, be able to talk about investments. And those are conversations that if you enjoy can really be a powerful part of how you increase your network surface area. And doors will pop open that you may never have expected. And I think that's something to really value and understand about being an individual angel investor. All right, so moving on. This is a slide that gets used a lot. So some of you who have maybe studied entrepreneurship have seen this before, because it's got the famous valley of death there at the bottom, where a startup is the red line moving through time from the very earliest stages on the left to the IPO stage on the right. And you can see that on the left-hand side, it starts off with who is really supporting the startup, and it's the co-founders. They're the ones with the idea and have to put in that early and hard work, whether it's time and capital, etc. And then the next stage is when angels start getting involved, and sort of the idea becomes investable, that there are some expectations of returns. This is where startup accelerators like Y Combinator or 500 Startups or Techstars come in. This is where angels often enter the picture. FFF stands for Friends, Family, and Fools. And that's just sort of a way to have fun with the idea that, yes, sometimes you're really just taking risk on the individual themselves, and you know that they can do it. And this stage and seed capital, you do see that some early stage funds, like the kind of work that Yoko and I do play at this stage. And what you'll also notice is that these are smaller amounts, and they're really to get through that valley of death to find that there is something there to stair step up on. And this next bar is really interesting because data, everything shows that there is more wealth creation happening in the private equity space than in the post-IPO, the public space. And that what used to happen with Microsoft going public was they went public at a very low, a modest, today's standards, valuation cap, market cap. And now they're like thousands of times what they were when they went public. Whereas you see other companies today delaying going public. The wealth that accrues and is created in this private equity space is now making a lot of financial advisors and portfolio strategists sort of rethink where allocations belong in portfolios, because there is a lot of wealth creation to be had here. You being able to get in as an angel in the early stages gives you access to that. I'd also like to point out that big ideas start little. So imagine Airbnb, just for example, on the far left. It was co-founders thinking that people might pay money to sleep on each other's sofas. And they tested it out by having people sleep in their apartment on air mattresses. And that was where they started. And everyone, a bunch of people thought that they were really, this was gonna go nowhere. And even they weren't really sure. And it was that sort of messy fumbling around stage that eventually led to a company that, while they're, obviously struggling right at this moment, has built themselves up, got through that valley of death, and became a much bigger thing. And now we sort of don't question the idea that we might go stay in each other's houses. So it's I want you to sort of see how a startup idea can start as messy and kind of wild and new, and then really become something that becomes part of our everyday fabric.
But also keep in mind how long that's taken. So they were founded in 2008. Well, 2008 is notable for a few different reasons. I think right now, especially looking at our current economic conditions, I think 2008 has some interesting comparisons. But also, yeah, it's been a long time for them to get through this. I think often founders and sometimes investors try to shrink the amount of time we think it's going to take for somebody to get to true value creation. Mm-hmm.
And notably, this next slide is one where it's something we talk about with founders, but I think it's relevant for investors too, as we start to think about ourselves as investors and how we look at a startup. The way that Yoko and I really like to think about a startup and want founders to think as well is that they're on this sliding scale of risk and value, right? At the beginning, it's all risk and nothing of value has really been built. A lot of times people will try and say, well, I have this billion-dollar idea, but it really at that point, it's all risk. And then as they de-risk that by getting paying customers, by developing and executing on a series of milestones, they're moving toward that value creation. And that unlocks different types of capital and different types of investors along the way, where you can see the faith, risk, and growth capital. So that's something that we also talk to and want to see from our founders, is that kind of understanding that do they understand where they are on the risk to value spectrum.
Great. And, you know, just making sure that we're sort of pegging things to the Pacific Northwest as well. Especially as an angel in this region, I've often felt a little bit of a chip on my shoulder. So I do want to get on my soapbox a little bit. You know, the 2018 Halo report, which is a report that they do just kind of angel activity. And from 2018, you can see that only 6.5% of angel deals were done in Seattle and in the Pacific Northwest. And I and many others, including I think Chris DeVore, wrote an op-ed in GeekWire, which is sort of a tech news source here in town. You know, he talks about how Seattle and the Pacific Northwest has such a wealth of talent, tech talent, deep experience in the space with Amazon, Microsoft, some of the largest tech companies in the world being here, headquartered here. So we have so much innovation being done here, but it continues to be overlooked by the market, the venture capital market. And so, you know, after I moved from the Bay Area here, I often told my friends, hey, Seattle is such a great place for building companies, for investing in companies. But I've been really feeling that a lot more. And I do think that we're at a sort of an inflection point where enough has been written, enough great companies have come out of the region that we are starting to see more people take a look at the opportunities here. You know, Minda and I are but one of like several firms that have popped up in the past year. And I think, again, those speak to the opportunities that are available. And I hope, you know, our goal is that it's great for the founders in the long run. So I just, you know, off soapbox, but that's my point of passion for the Pacific Northwest.
Yoko and I were both born and raised in the Pacific Northwest, so we have some time in California, but you know, we're on the hometown team here. So
it's true. So some bad news though. You know, I think in terms of what you should be looking for, we'll talk about a few things. And one is that there should be some expectation of failure. Like I don't go into investing into companies saying like, oh, they will probably fail. All of my companies I invest into will be my winner. But the reality is that 70% of tech companies do fail, or startups do fail, usually around 20 months. After raising their financing. So I think it's something that's always important to keep in mind. You know, the failures also, if you think about the fact that the average holding time for successes is 4.5 years, or to IPO now we're seeing 10 to 15 years. You know, your successes come in the long run. The returns will come much later on than your failures. In your first, you know, 1-2 years, you'll start to see those failures add up. And I think that can be a really scary moment. So that's, you know, just one thing I want to mention.
So sort of just my point of view on that too, is that as you look at the fact that you will have failures that of course you believe in the beginning, startup failure, having a bad outcome on an investment, might be different than having made a bad decision. So it's really good to decouple those and focus on building your decision-making skills about the investment, because you can't control the outcome. All right, next one. Yoko, you want to?
Oh, great. Okay, so I guess kind of taking a quick moment from us talking at you, but like, you know, I think if you were digging into a specific area, whether it's product traction, market, you saw some of those failure reasons, right? When you're evaluating company, put on your investor hat and like, what is the one area that you dig first and deepest, and why? And just drop that in the chat, because I think I'd love to see a little bit of the variety. I think one thing you'll probably see is that our experience is often what shows up. I was a product manager, and so for me, like, I want to know about your product. I want to dig in deep to that. You know, often with Techstars, for example, they say team, 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 right? And so they want to dig deep on the team, and why is this the team that matters? Jessica, you also believe in that. And so, and one note on the team, I heard, I think Sarah Imbach, who's one of the super angels in town, talks about this a lot, where she says, is this the team that you'd hire to solve this problem? And I just love that, because there's a ton of great teams out there, but is that the team that's specifically like the superstars for this problem?
We call it founder problem fit. So does the you know, it may be the right problem to solve, but are they the ones to solve it? Are they the ones who are going to be able to navigate the twists and turns of solving that problem? Or are they too, you know, maybe just like overly, like, if the technical solution they have in mind doesn't work out, they don't have enough market knowledge to be able to navigate a direction change.
And it looks, one more thing.
Excited about the market, having over the course of, you know, several cycles, seeing new markets emerge. And I'm always really curious to see and think about what market is. So for me, I like thinking about the market opportunity as.
And a lot of times folks do, you know, the reason why people focus on billion-dollar, trillion-dollar markets is if you can even get a small percentage of that, that's a pretty large company. So, you know, I think that's always a good thing. If you talk to a company, they say, well, my target market is really $50 million. And it's like, oh boy, like, if you get you know, again, the numbers start to get smaller. So I think that's important. One thing I'll mention about, a couple of folks have talked about sustainable tech, so conservation, energy. And one thing I'll mention about those spaces, I have not invested in any companies in that space, partly because of, I don't have the background to really understand them well. But especially with sort of those systems change and hardware focused things, they do have a different time horizon than, say, a software technology company. So, and
sometimes a different capitalization need as well. Yeah. Biotech is the same way. I noticed that someone also put in here the marketing strategy, not just product. The go-to-market strategy is another area that I love diving into.
Cool. So keeping us moving through a little bit more content here. Minda, you want to talk about the strategy?
Yeah, so this, we were kind of alluding to this earlier, talking a little bit about diversification. And so I want to cover a fact that, you know, number of deals is pretty obvious. You want, like, there's sort of the math around having at least 20 deals to be able to have some expectation of a portfolio that returns. So for example, when Joni was sharing her example of a portfolio of 2, that's extremely high risk. So your risk starts going down and your returns start getting more probable as you increase that. Vintage, meaning, let's say you decide to set aside $250,000 and you go out and you invest it all in the first year, when what is hot? Machine learning. Everybody's all about machine learning. Well, the macro trend 3 years later might be something different, and you might be overweighted in one technology. And so thinking about vintage sector, if you invest all in healthcare and nowhere else, then maybe that's okay, maybe that's your strategy, but it's another area you can diversify in geography. Then I'm going to talk about the your allocation to this asset class. So this gets back to something we mentioned earlier, and I saw a question pop in, which is, you know, we talked about setting, you know, 5 to 10% of your investable assets aside, and that also is what unlocks different ways for you to build your portfolio. And I want to cover 3 areas that really sort of opens up. And the first one is, if you have $100,000 that you can do this with, the minimum, so what that really allows you into is the syndicate, when angels pool their money to write a single check to a startup. And so maybe it's just $5,000 per investment. 5,000 times 20 is $100,000. So you're sort of looking at a portfolio there. Those often happen through groups, because the minimum usual check size for a startup to take as a direct investment is usually around $25,000. Sometimes it'll be as high as 50. It's always negotiable, but generally expect that. So if you have that amount, then you're looking at a much higher number when you multiply that by 20. So you can think about maybe a mix of syndicates and direct investments as a way to approach your portfolio. Another opportunity, like we've been talking about, are these early stage funds where you can invest maybe $100,000. And if their portfolio strategy is to bring 15, 20 companies in, why you might save time because they do all of the due diligence and sourcing work. And maybe, you know, depending on how they're structured, you get involved, but they're doing the diversification for you. The more money you have, you can employ all of these options. So if you're doing $1 million allocation and spending that into startups over 5 years, you can look at a mix of funds and syndicates and direct investments, and you can build your strategy around that.
And in addition to kind of thinking about the portfolio strategy, I also, you know, when you're listening to a company pitch, initially, you know, it feels a little bit daunting. I don't know anything about the space. I don't know anything about startups. But the reality is, I think we actually, I mean, if you're on this call, my sense is that you have evaluated whether it's new hires or a new strategy for your business. And so what's really important is, do you hear a really believable plan? And that believable plan isn't just, hey, I'm going to take your angel check and I'm going to go to the moon, because that's not reality. I would say, I'm going to take your angel check, I'm going to figure out how to get my car running, and then I'm going to get it to the launch pad. And at the launch pad, I'll need these milestones to get folks to give me the fuel to send the rocket to the moon, right? So really seeing that the founder has a clear understanding of the types of rounds of funding that we'll need and the types of milestones that will be the unlocking mechanism for that next round of funding. I think those are the things that I'm listening for at a very basic level.
I think that is the Mad Libs of investing.
Yes. So, you know, we've talked at you a lot. We really want to get into the breakout room. So we'll breeze through these. I will send in the chat a link to our sort of reading list, which includes all the links to the material, the articles and the books that we're going to talk about in the next few slides. Minda, you want to talk about these?
Yeah. Okay, so I'm going to start at the bottom. VC Twitter is one of my favorite places to hang out. VC Twitter means just like following all these different investors with all their different points of views and them arguing with each other. And, you know, there's a lot of like macho stuff that goes on there too. You can ignore that. You can follow the ones that you want to hear from. But what you do see is some sometimes really thoughtful discussion about what does it mean? Is investing happening with VCs and angels during COVID? And different thought leaders providing a point of view on that. You'll get links to blogs, and really it's about exploring different points of view and different people's experience and data points, and finding some people where you are interested in their voice and want to kind of follow what they do. And I found that to be a terrific place to learn. I think other seminal books are Venture Deals by Brad Feld, who founded Techstars. Yoko and I we find it like a textbook for understanding deal terms, terminology, and sort of how deal making happens throughout the life cycle.
And the book that often we recommend to angels just getting started is Angel Investing by David Rose. It's similar take. David Rose is a super angel out in New York, I think. And so again, it gives you sort of the nuts and bolts of what angel investing looks like. I also threw in this How I Built This podcast because, again, as an angel or as an investor, you will always want to be thinking about how other founders created value. And I just, every episode I listen to, there's something that, like, you know, I take away that changes my life, I feel like. Also, there's a ton of events and, you know, virtual and whatever in the community. I think what's really important is to just start somewhere, go to some events, start hearing some pitches, form opinions, ask others what they think. You don't feel like you need to write big checks right away. In fact, I would recommend not. You know, it's I think it's important to sort of make sure you see a wide range of pitches before you start writing that check. You know, these are some great places to start. The Seattle Angel Conference, for example, is a 10-week program that, you know, with a small investment, $5,000, to really go through the nuts and bolts of angel investing with a group. So Shark Tank in slow motion. It's a great resource in the community. And then, you know, the last bit we'll talk about is or the last two things we'll talk about. One is angel groups. So there's a list of them. They're also linked in an article that Minda wrote that's included in our reading list. Angel groups are a great way to diversify your thinking, to share your deal flow and the workload. It's important to know that they all sort of differ by stage and focus, and some have membership fees, some don't. So useful to take a look at. And then of course, you know, with early stage funds, there's been a lot of great research done that new and developing funds are consistently among the top 10 performers. This is from a study by Cambridge Associates from 2019. And I think what we're seeing is that there's a lot more early stage funds being started by former operators. And that's a group that a cohort that we are proud to be a part of. And I think that, again, these are people who know and love the messy earliest stages of companies. And I think that's so fantastic. And as I referenced earlier, in Seattle, we're seeing a bunch of early stage funds popping up, and I couldn't be more excited about the opportunities that this gives to founders. I also see it as a great way to diversify your portfolio in different ways. So I joined a fund for the first time as an LP this past year, and the reason why I joined that fund was that the founder had a different view or different expertise. She's deep into consumer, and she's in the LA region. So again, it's a geo and a sector that I don't have as much experience in. So for me, it's a really great way to diversify my portfolio because my husband and I have ended up doing a lot of tech and dev tools just because of his background in that side of things. Oh, and thank you. EA Angels was not on that list. It is on Minda's list in the article, but thank you very much. Yeah, they do impact investing. They used to focus on clean tech only, but all right. So we've
especially, I should say, and they specialize in clean tech. And so if someone is interested in that area, they're a great specialty group.
So we've blown through a ton of content. We'd love to hear from you. I think the two breakout areas, one, Minda will be covering kind of due diligence and the types of questions to ask. I'll be talking a little bit about building portfolios. And so,
we're going to randomly be sorted into two groups. And so then we'll just come back and summarize. So hopefully you won't really miss anything.
Let's come back in by 5:50, so it'll be a short breakout.
Yep.
Okay, so here we go.
Hey, Joni, can you put me in a different breakout room? I was in the same one as Minda.
I think you can ask to be moved.
Oh, wait. Okay, let's see. Can you assign me to a different one?
Let's see.
I've been assigned to breakout room 2.
Yeah. There you go.
Oh, great. Looks like folks are coming back.
They're coming back now.
Wonderful.
So about 40 seconds, Yoko.
Yep. And I just sent a note to Minda to come back to the main session.
I closed her off.
Oh, good.
Yeah, all set. Everybody should be back in about 5 seconds.
Wonderful.
You don't get to tell that story.
All right, Minda, we're back.
Yay. All right. So Yoko, what did you guys talk about?
You know, we talked a little bit about minimum check sizes and how that dictates portfolio, how syndicates form. So, you know, what the pros and cons, I guess, of that. With syndicates, it's really around being able to do a slightly lower check size. I also talked a little bit about how Techstars and YC and those types of accelerators can be a great way to do an initial filter on a lot of the companies that are out there. So they have to, you know, they have a specific criteria that they need to meet. That being said, Techstars has like 7 to 8, YC the last class at 200. So, you know, there's a little bit of a balance there. Something in the middle would be nice. I don't know, what else do we talk about? I feel like the time went by really fast.
Well, I'll give you guys a quick summary of what we talked about, and if you guys want to go back to that. So we talked a little bit about red flags that can come up during due diligence.
Mm-hmm.
What those look like, and how do you find those? And so I talked about some of the friction points that cap tables have created, and that's usually one of the first places to look for me, and understand if the founder has put in a loan and it's not properly documented and needs to be sort of stated properly so that as investor money comes in, it's not going out the back, and just all these sort of mechanics about having a very cleanly presented cap table that shows good amount of representation for who's really the contributors to that company, and making sure that that everything aligns with what is true about who's involved and how much they're really contributing financially and time-wise and leadership-wise. It's like great to see 4 founders that are all working together, but that if they just divided it up between the 4 of them equally, then that tells me that maybe they just did it for it to be easy, but it really doesn't represent the amount of you know, value to them brings. Maybe there are 2 that really make the decisions. That needs to be reflected in the cap table. So those things carry forward in a big and more amplified way later.
Yeah, it's a great point. Well, should we just switch to just any Q&A for the last 5 minutes? Oh, actually, feel free. What's the best way to do this? We can, there's only 20 so right now, so we can, you know, I think if you have questions, let's just pipe up and we'll answer them directly.
What do you guys think is the best, this is Emily, what do you guys think is the best way to source sort of deal flow, if you will, if you want to just sort of wade into the water? Obviously check size is a factor that kicks in there, but even if you just want to start having conversations to receive, you know, to be able to speak to founders, get the pitches in hand, go through the process a few times to sort of decide what your right avenue is, what would you recommend for that?
I think, you know, just attending events. There's a number of events in town. So like Founders Live is a great way to see super early deal flow. I would say a lot of the founders I see at Founders Live, I might see them actually fundraising in the, you know, in a year or so, or 6 months to a year. And so it's a great way to see where companies start. And it's also a good place to understand like, or be able to sort of recognize some of the gaping holes that a company will have. In most companies, even the ones we invest in the earliest stages, there will be some gaping holes in their story that, and if they're aware of them, great, right? But it's really, I think it's a good way to have exposure to a lot of deals. Startups Meet Angels. I don't know is that event still happening, Minda?
I think it hasn't happened recently, and certainly not under COVID, but my short answer to that question, Emily, is joining angel groups, because that's the fastest, quickest way to get a wide top of the funnel and hear a bunch of different people's points of view. And, you know, it also sort of allows, it's really interesting in angel groups how people sort of find each other, where they're sort of like-minded, or sort of, you know, find that they enjoy looking at the same kinds of deals. And so even if you don't stick around with that group, you might find just a few buddies, and that can become, well, that's what happened with Grub Stakes, right?
Yeah.
It all started with like Seattle Angel Conference, and it was kind of like, hey, we kind of like doing this together. Let's just let's make a new group. And now that now Grub Stakes has been around for 3 or 4 years and has like 50 members. So things ebb and flow, but groups are great.
Thank you.
All right.
So I think that this is a good place to stop for today, since we're almost at 6 o'clock. So thank you so much, Monica.